everyone, and thank you for watching my videos. I've mentioned numerous times in my previous videos that it's very important to place stop losses when we open our positions. So what I want to do in this video is I want to show every investor out there how to place the stop loss and also provide even more information about stop losses. So in this video, the primary and exclusive objective is to learn as much detail as we possibly can about placing stop losses. So let's talk about what you already should know about stop losses. So we already know that being in a losing position cannot be avoided. So it's not about win or lose, it's mainly how much we can gain and how little we can lose. Because what we have to think about here is this. A great investor is an investor that is not concerned with a profitable trade or a losing trade, but rather keeping the losing trades minimal so we can survive in this market long enough to take advantage of the big opportunities. And there are opportunities out there, but if our accounts are weak, we can't take advantage of those big opportunities. So we need to keep our accounts strong so we can grasp the opportunities for big profit. But we can't do that unless we understand the full concept of stop loss. Okay, so there are 4 types of stop loss. There's equity stop loss, volatility stop loss, chart stop loss, and time stop loss. So first, let's talk about equity. Equity just refers to the fact that we need to set our stops according to the market environment or according to your trading rules. So remember, setting your rules is very important because that's what helps build discipline and that's what helps us make solid decisions and that's what helps us become successful in this market. Also, the percentage risk can vary from trader to trader. So again, how much you're willing to risk? Do you want to risk 1% of your balance or 5% of your balance? It's up to you. And also, you must consider the nature of the pair and how much movement that takes place in the pair. So for example, let's say we have this market here, this pound-dollar pair, and it's an hourly chart. And notice that we have a bearish candle resting right on top of this resistance line. So we decided to go short. And we decided to place a 10 pip stop loss. Now, this is probably a very conservative decision. So 10 pips that, a market like this pound-dollar pair, it does have some volatility. So is it wise to set a stop loss so tightly? Well, let's see what happens. And as we can see, our stop was too tight because that bullish candle that was testing the line of resistance, it did jump past the line of resistance, but it was only testing it. And as we can see, we have this big shadow and such a small body, and it did retrace from that line of resistance and the bear market has begun. However, we were not able to make any profit because that upper body hit our stop loss and our account or our position closed automatically. So we have to be careful with where we place our stop losses because we want to give ourselves a chance to make a profit. We have to also anticipate that maybe in the beginning the direction of the market will go in the opposite from where we can make our profit, but it will eventually reverse itself. So here's what we have to keep in mind. If you're having trouble widening your stop losses, then maybe we should open up a smaller account that has less pip values. And also, if we can't do that, then what we need to do is we need to add more funds to our account. So again, we don't want our stop losses to be too tight. Like, we need to have some sort of room just in case the market does reverse itself, but maybe not reverse itself at the point where we enter the market, but give yourself some chance, and also give yourself some patience too. So again, we don't want our, again, we should keep our, we should, I mean, when we set our stop losses, I mean, don't set them too far from where we open them, but don't set it too close either, because again, we miss opportunities that way. And also, and again, I tell this to every new investor, you know, just avoid trading the pound until we have enough funds in our account to where we can cover the volatility involving the British pound. And also the fact that the British pound has, any pair involving the British pound has such a high pip value and the spreads are too far. So if your account balance is low, trading the British pound can hurt your account if it goes the opposite way. Okay, so that's it for equity stop loss. Let's talk about chart stop loss. So here's what we need to know. One of the things that we can observe in price action is that there are times when prices can't seem to push or break beyond those certain levels, meaning it's a really slow market and there's not too much volatility. So here, as we can see, there's some consolidation on this line chart. So the question is, where do we enter the market and how do we place that stop loss? Well, if we look here at this line of support, it was tested 3 times. So some people might suggest that we should go long after the line of support was tested, the 3rd line. And however, we should place our stop loss somewhere below the line of resistance. So as we can see right here, I'll go back a little bit further because I know I went too fast. So the line of support was breached 3 times. And then we seem to have a bullish trend, breaking that line of resistance. That could be an indication that a bullish trend has begun. Maybe. So we get into the market, we go long, but according with our chart, we want to place our stop below the line of resistance where it was breached. And now let's talk about volatility stop loss. Volatility stop loss works like this. We know how much a currency pair tends to move, and by setting the correct stop loss levels, we can avoid prematurely being taken out of the trade on random fluctuations of a price. So going back to the equity stop loss, we were taken out of that trade when that line of resistance was tested, and it was tested only a short time. And with our stop loss set too tightly, we missed out on a really great bearish trend. And also, in the volatility stop loss, knowing the average volatility helps you set your stops to give you trade a little breathing room and also a chance to be right. So again, what we're looking for is we need to play it safe. We need to make sure that we are not losing more than we have predetermined that we can lose. For example, if you're a 1% trader, that means we set our stop losses at the point to where we are not losing more than 1% of your balance. So again, that's one way that's an excellent way, and that's actually how most traders work their strategy regarding stop loss. So here we have a ranging market, and here we've got the Bollinger Bands on this pound-dollar pair. So some people, if they decide to go long or go short, will place the stop loss right above the line of resistance, but with some significant distance, not right above the line of resistance. Again, we're talking about breathing room. So if you decide to go short in this pair that appears to be ranging, we can place our stop loss, which does appear to be along the, which appears to be along the lines of a Fibonacci extension, or you can place your loss, stop loss, right below the line of support if you decide to go long. So again, we're prepared for either way. Now let's talk about volatility stop loss before we go to the fourth one. So if you look at an hourly chart and you type 30 into the settings, the indicator will calculate the average pip movement of the last 30 hours. So you already know that because I did a video on moving averages. So here's some more information about volatility stop loss. If you look at a daily chart and type in 25 into the settings, the indicator will calculate the average pip movements for the past 25 days. So again, we're using moving averages and Bollinger Bands to help us determine some good places and some key areas to use the volatility stop loss. So as we can see, the market is ranging. We have our lines of support and resistance, and it appears that in this market right here, which is the pound dollar market, and we're looking at an hourly chart, the movements are within 150 pips. And we have typed 50 into the settings according to the technical indicators to give us these two lines. So if we decide to short this pair, we place our stop loss slightly above the line of resistance, or above the, or right below the line of support if we decide to go long. So placing your stop losses at a level that's above the lines of above the line of resistance or below the line of support, that's a great way of determining your stop losses based on how volatile the market is. Okay, so now let's look at time stop losses. Now here's what we need to know. Time stops are stops that are based on a predetermined time in a trade, and it's based on a specific period in the trading session. So here we have a slow moving market, and let's say we decided to go long. However, this market has been flat for a long period of time. This appears to be a Euro franc chart, and it's an hourly chart. Notice how flat the market has been. And usually when a market has been flat for such a long time, it's very difficult to determine whether or not a bearish trend will break out or a bullish trend will break out. So if we open a long position and we haven't seen any type of trending so far, what some investors will do is they'll place a stop loss right below the range, because when we have such a long period of inactivity, what usually happens is when the market begins to break one of the lines of support and resistance, it tends to continue. So what the investor here did was, this was to determine where the line of support was in this ranging pair. And since the investor chose to go long, the stop loss was placed right below that line of support. So I indicated that right here. So after 3 days of no action, then we probably should get out of the market. So that's an example of time stop loss, and it looks like the investor made the right decision because the market indeed went bearish. And maybe the investor could have made a small profit from what appeared to be a few bullish candles, but again, the market was really weak, so it wasn't worth it. And also, here's another benefit with time stop loss. It keeps us in the market to where we can look for other opportunities. So we close this position, and also if we lose, if this position is a losing position, we've lost only a small amount of our balance, maybe only 1% of our balance. So we look for other charts, and after closing this position, we jump into a different pair and we go along on that pair and look how big our profit is. So you see, it's not about avoiding avoiding the losing profits and only looking for positions that we can gain, because we always lose and we always win. But what we're trying to do is we're trying to increase our profits but minimize the capital that we are going to lose. Because by minimizing the capital that we lose, we still have enough energy to find those big profits. Okay, so let's talk about some mistakes when we set stop losses. Many people set their stop losses too tight, not giving yourself a chance to look for those big profits. Also, determining the stop loss based on the size of the order. So we want to study the chart first and look at the patterns and use those tools in your technical indicators. That can also help you determine where the stop loss should be. And also placing stop losses too far. So some people, they feel a little desperate. They really want that big profit on the position that you've opened, and they're not willing to concede defeat. So don't set your stop losses too far, because we lose too much of our capital that way. And also, don't place your stop loss exactly on the support resistance level. So give yourself a little bit of distance, because support and resistance levels, they get tested all the time. They get breached all the time, but those breaches are usually a result of fake outs or false breakouts. Maybe something happened in the news that caused that fake out, but many investors realize that piece of news information is not that important, so the value of the chart fell back into its place. So don't place your stop losses exactly on those levels. Okay, so let's talk about how to execute stops. Now, if the market has reached your stop, the reason for the trade is no longer valid and it's time to close out. So just remember that you placed your stop loss for a reason, and it's because when the market is in that area, then there's no chance that there will be another trend. So if we're going long on a pair and the market goes the opposite direction, heads in a bearish direction, that stop loss means that there's no chance that the market will be bullish. So that's why we use our stop losses. And also, never let your emotions cloud your judgment, because it's very difficult to make successful trades when you're trading on emotion. And trail your stops, don't widen them. Meaning, if you're making great gains on the position that you open, move that stop loss to where it follows your profit area, so you don't lose much of your profit. Okay, so here's what we've learned. We've learned that there are many different types of stop loss, and we also have determined that setting the stop losses in the right area can help us save a lot of our capital that we would lose if our investment turned out to be a bad investment. So, and also, find a broker that allows you to trade position sizes that suits the size of your capital and risk management rules. So some people find it very difficult to set stop losses properly, only because the accounts are too small and there's not enough capital in the account to cover those stop losses. So we also have to think about that. So make sure that when you open up your accounts, that your accounts are properly funded, and stay away from these $250 minimum, $500 minimum. You don't want to do that. So put a decent sized capital in your account, and if you're not able to do that, well, you can still get involved anyways, but just be careful and try to keep the sizes of your position small, and trying to not to invest too much in the British pound. And also use limit orders to close out your trade. So again, if we are satisfied with your profit, there should be a limit as far as how much we can make on this investment, and then your trading platform will automatically close your account and you'll immediately have that profit into your equity. So, and also remember to record and review your thought processes and trade outcomes in your journal. Then you will be one step closer to becoming a professional and successful risk manager. So, as I mentioned previously, that making a journal is important because every piece of information that we accumulate from this market gives us the experience that we need to become successful investors. Thank you for watching my video, and good trading.